Imagine a country where political pressure overrides economic logic, where central bank independence is eroded, inflation spirals completely out of control, and the currency plummets in value. Sound like a far off crisis? Think again. This is Turkey's story, but it's starting to feel eerily similar here in the US. Today, we're diving into Turkey's wild ride of monetary and fiscal chaos, skyrocketing inflation, manipulated interest rates, soaring bond yields, and a collapsing currency, and asking, could the US be headed down a similar path? And if so, what might it look like? So, President Trump, for those that are not aware, fired the BLS commissioner on Friday. A BLS is a government agency called the Bureau of Labor and Statistics. They put out a all sorts of economic data. Trump did not like the data they put out and fired the BLS commissioner. Over the weekend, a lot of people are noting that the U.S. is experiencing or expressing emerging market-like characteristics. This is actually a theme that we have been talking about going back to the summer of last year. So it did not just start. It has been in motion. And in this video, we're going to try to take a look at one of those emerging markets that went through an economic crisis, currency crisis, to see what are the turning points, what are the signposts, how does it actually happen, and what are some warning signs to look for. Now, there are a couple important disclaimers. Turkey does not have the reserve currency status that the dollar does, and they do not have the strength of the U.S. consumer nor the exceptionalism of U.S. corporations. Now, with those disclaimers out of the way, we can look at a couple main accounts that are important to bear in mind as we get into some of the timeline. I have a whole timeline prepared here that we will get into. Here we're looking at budget deficit as a share of GDP. This is the fiscal deficit or difference between government spending, government revenue. And then in red, we have the current account deficit. This is basically the balance of trade as a share of GDP. We can see Turkey runs a twin deficit. Well, the US also runs a twin deficit, although ours is much larger. So our current account deficit, if you annualize out the last current account print, is an utterly insane 6% of GDP. This is what led to the housing bubble and the subsequent collapse during the GFC. And we are running a 6% of GDP current account deficit and also an equally insane 7% fiscal deficit as a share of GDP. It makes 2-3% look very tame in comparison. Now, the other important metric to look at is debt to GDP. We can see Turkey's debt to GDP has been declining from about 65% down to just 24%. Very, very low. This is despite government debt looking like a hockey stick. Well, we'll get into how they did that, how they were able to do it. It's not without consequence. Debt to GDP for the US, on the other hand, has doubled over the past 20 years or so. So, with that out of the way, let's get into this timeline. So, in July of 2016, there's a failed coup attempt on President Erdogan. Now, bear in mind, their central bank is called the CBRT. This is their version of the Federal Reserve. And there was a huge fiscal expansion, huge amount of government spending going on by the government. Well, after that coup attempt, President Erdogan consolidated power. Now, inflation was running at like 7 or 8%. Again, bear in mind the scale here. Inflation was running at 7 or 8% and low interest rates, despite this inflation and despite this political volatility. President Erdogan continued to push for kind of a consolidation of power, an erosion of independence. And this included the central bank as well. So in December 2016, the credit downgrades begin. Now we know the US credit rating has been downgraded similarly over the past 10 years or so. Well, they start getting downgraded despite having a relatively low debt to GDP. And this was mainly because of that consolidation of power, that erosion of central bank independence. This guy named Murat was appointed the CBRT governor in April. And initially, people thought that he was basically a government puppet. But as we will see, that's not how it played out. In April 2017, there was a further consolidation of power after the constitutional referendum passed. This further eroded the autonomy of the central bank, and the fiscal expansion or government spending continues. Now, another similarity a lot of this fiscal expansion was populist sort of policies, tax breaks, right? No tax on tips, no tax on overtime, things like that, as well as subsidies. So, say what you will about Trump. The one thing we kind of, hopefully, every American can agree on is that he is very populist, and we are in kind of this populist era on both wings. It's just different flavors of populism. Well, this is not to claim that a certain flavor of populism is good or bad. The point here is populism from an economic standpoint is all kind of the same, which is it increases deficits, right? Populism is very expensive. It increases deficits and generally is inflationary. So in May of 2018, Erdogan continues to kind of, we can see here that inflation started to pick up. So the central bank raised rates. Marat raised rates to 18%. Well, this very much angered the President Erdogan, and he railed against these higher interest rates. Again, sound familiar? And he called them the mother of all evils. Now, shortly thereafter, the U.S. Erdogan appointed his son-in-law, by the way, as finance minister. Shortly thereafter, there was sanctions imposed by the U.S. We can see that here in August of 2018. Sanctions were imposed. This is usually catastrophic if the U.S. imposes sanctions on you. Well, we can see the lira declined significantly, very, very sharply during this period of time after he railed against the higher rates and was pushing for lower interest rates despite inflation picking up. Again, sound familiar? And then, the appointment of his son-in-law, just kind of outright cronyism. We have not seen anything like that yet, but he appointed just an outright puppet. And we can see that the Turkish lira did not like that. So in August of 2018 is really when the lira crisis kind of started. The CBRT had raised rates. The central bank had raised rates by about 600 basis points, all the way up to 24% in September, but it was seen as reactive and not independent. So again, remember, everyone thought Marat, this central bank governor, would be basically a puppet. Well, he was raising rates despite Erdogan railing against the higher rates and really clashing with him. Well, he was sacked for resisting rate cuts. This happened in July of 2019. Here, I will put my cursor over it. July of 2019, he was sacked by President Erdogan for resisting rate cuts. This was despite an interest rate of about 18%. Despite that, inflation had actually finally started to fall, and they were finally starting to get inflation under control. We can see inflation was below the central bank interest rate. This is generally seen as restrictive monetary policy and a sign that the higher interest rate is working. Well, because he was sacked and a puppet was installed, we can see the lira continues to depreciate as further erosion of central bank independence and really outright fiscal dominance starts to take hold. Fiscal dominance, we've done videos on this in depth, but fiscal dominance is when the central bank starts acting as an arm of a government agency. We have people calling for a reversal of the 1951 Treasury Fed Accord, and basically the Federal Reserve would cease to be an independent central bank and would just become an arm of the Treasury. That is fiscal dominance, and by 2019, fiscal dominance was really, really taking hold. Well, in 2019, 2020, the CBRT starts some really unorthodox policies. We can see here they cut interest rates despite inflation never going below 9%. They cut rates from 24% to 8%. Despite this very high inflation, this fueled even more depreciation in the currency. And then in November 2020, there was kind of this brief shift where we can see after the rate cuts, they started to behave much more responsibly. They raised rates from about 8% all the way up to 16%. So that's a doubling in that overnight interest rate. So November 2020, that is when the rate hikes started. Well, again, President Erdogan did not like that and sacked the CBRT governor, and this person named Abgal was appointed the new CBRT governor. So this is happening multiple times already, just in the span of a couple of years. Well, Erdogan did not like the fact that he had raised rates. Now, inflation again bottomed here in 2019 at 9%. and basically was moving higher, ever since, right? And so raising rates was a smart thing to do. But again, Erdogan didn't like that. He had called high rates the mother of all evils back here, and previously sacked someone for not cutting interest rates when inflation was like 10, 11, 12%. He did not like those higher rates. So he appointed this person, Abgal, as the new governor to hopefully kind of stabilize the situation. The finance minister, the son-in-law that had been appointed, he resigns as finance minister, and the fiscal deficit continues to kind of worsen due to all that populist spending to about 3.5% here. As we can see, the white line is the fiscal deficit. We can see that here in 2017, 2020 is where we are right now. 2020, the fiscal deficit was running at about 4% of GDP. This is significant, by the way. Even though the US runs a 7% deficit, anything really over 2 or 3% is significant. Well, in March of 2021, Abgal is dismissed. The CBRT governor that had been appointed, he's dismissed. So this is like dismissal number 3 of central bank governors. He's sacked after raising rates to 19%. Again, Erdogan really didn't like that, so he sacked Abgal and appointed another CBRT governor that he would hope would be, more favorable. Well, that day, that one day where he fired Abgal, which was governor number 2 or 3, in one day the lira fell 10%, just because it was such outright cronyism, outright fiscal dominance, that the lira fell 10% just that one day alone. November 2021, there was what Erdogan called a economic war of independence. And this was in November of 2021. Here, we can see this is right before inflation started to really take off. Inflation at this time was running at about 20%. And again, he had installed a puppet that was not going to raise rates. We can see the interest rate remained at 15% despite inflation, again, bottoming at 9% all the way back here and just heading higher. That prior governor had tried a rate hike. Erdogan didn't like it, sacked him, installed yet another one, yet another puppet, and inflation continues higher, higher and higher and higher, and the central bank was not raising rates. In November 2021, there was this economic war of independence, and inflation would hit 85% shortly thereafter in 2022. This is the peak of the crisis in 2022. We can see that despite, again, this rising inflation from 9% all the way up to about 21% here in November 2021, the central bank actually cut interest rates. So the interest rate at that time, or going into that time, was about 15%, and inflation was about 21%. And again, it was just heading up and to the right. And what did they do? They actually cut interest rates. Well, look at what happened to the lira during this time. It just fell off a cliff. And then also look at what happened to the inflation rate. It was shortly thereafter that inflation really took off. We can see the depreciation in the lira accelerated, kind of waterfall motion in the lira, and inflation would just start to kind of take off. Well, October 2022, this was kind of the peak crisis period of time. Inflation reached 85%, and the CBRT cut rates. So here we can see that inflation reached 85% in October 2022, and look at what the interest rate did. This new puppet, I think it's governor number 3 that we're on by now. The new governor cuts interest rates in spite of 85% inflation. This could not be more unorthodox to cut interest rates, even back here with inflation so much higher, but especially with inflation at 85%. To cut interest rates is really kind of incredible. Well, this was defying the kind of predominant orthodoxy with how monetary policy should be conducted. And the lira had lost, between 2021 and 2022, the lira lost 50% of its value during that time period. The fiscal deficit was also worsening. There was a big earthquake in Turkey. And again, that populist spending, again, very similar to what's going on in the US, that was drawing on the deficit. So we can see here in 2021, 2022, the budget deficit reached about 5% of GDP. This is very significant, especially if you're not the reserve currency issuer. May, June of 2023, there was kind of a return of some orthodoxy. We can see that here. May of 2023, the lira had already just absolutely plummeted in value. Inflation was running at about 39-40%, and interest rates were quite low compared to the inflation rate. Well, there was an election then, and after that election, the finance minister installed yet another CBRT governor. And that person actually had much more of an orthodox view of kind of higher rates. So they actually tightened policy and they raised rates from 8.5% to 25% by August in order to curb the still high, still very, very high inflation, as we can see here in the yellow line. Inflation remained very high, and they kind of returned to orthodoxy, started to raise rates. Well, what did we see? We see that inflation started to actually accelerate. It made a bottom here in June of 2023 at about 39-40%. And as they raised rates, we can see that inflation headed higher. And again reached a very, very high level of 75% by May of 2024. So as inflation is rising, they're raising rates. That new governor, I think it's number 4 by now, he's replaced by yet another one. And the fiscal deficit remains very, very, very large at about 4 to 5% of GDP. They were garnering some foreign investment, what's called FDI, foreign direct investment. By September 2024, inflation had fallen to about 50%. So we're up to here in April, May of 2024. Inflation peaked here at 75% and starts falling despite an interest rate of about 50%. Remember, when you're raising rates, whether it's in Turkey or the US, it is not an immediate impact. So it looks counterintuitive and it makes you wonder if Erdogan had a point about higher rates, right? When you see after this long period of very low, relative to inflation, very low rates, you see as soon as they start raising rates, that is the bottom in inflation and it starts going up. It would seem that maybe Erdogan was onto something, but you have to remember monetary policy, it's like a glacier. It moves, it's a very, very powerful force, something like an interest rate, but it takes forever to exert its impact. So by 2024, they had raised rates all the way up to 50%, and those, that lagged monetary policy, long and variable lags, as they say, started to take effect and inflation started to fall. And we can see that currently it's at 35%. The central bank has cut rates a couple times from November, about 7 basis points or so. And so things have kind of stabilized. That is basically the overview of what happened. I want to show, though, what it looks like in terms of asset prices. So here's the stock market in white. We have, I'm going to take off the inflation rate here in blue. And here we have in white, in lira terms, the stock market. And we can see that during this time period, right, here's 2020. So from 2020 up until 2024, we can take a measurement here, March of 2020 up to 2024, the stock market rose by 1,000%. Now, again, this most normal people would look at this and go, well, this is great. The stock market rose by 1,000% in just 4 years. Well, again, it goes to the collapsing value of the denominator. If the denominator is plummeting in value and purchasing power, yes, you are going to get a stock market that looks like this. Here in red is the gold price in Turkish lira. But again, if we adjust for that kind of failing denominator and look at it in US dollar terms, we can see that the return was not nearly as much. It was about 100% from 2020 up until 2024. So again, adjusting for the failing currency, you can see that it barely even set a new all-time high. Going back to 2018, it had this high here, the stock market, in dollar terms. So again, adjusting for the failing currency. And it barely broke above that before it just headed lower. So, in nominal current, local currency terms, a country going through an emerging market debt crisis or currency crisis, you will see both the gold price and the stock market do this as people seek to protect their purchasing power. They buy assets, whether that's gold or whether that's the stock market. And so, and real estate as well. Generally, you will see real estate values go higher as well. This is similar to what we've already seen over the past 5 years in America. We know that the average home price has just absolutely skyrocketed as the government printed 40% of all dollars ever created and injected those into the economy. Well, there are only so many homes. There are only so many ounces of gold. If you double the amount of monetary units by printing money, and then flood those monetary units into the economy, you will see higher prices. Again, that does not mean it is more valuable. The other way you can think of this red line, which is gold price in Turkish lira, is you can invert it to see the purchasing power in gold of the Turkish lira. So you can think of this as gold lira, and if you invert it and look at it this way, it's lira gold. And we can see that it's just a waterfall. It is beyond words how much the currency collapsed during this time period. You will get optical illusions. You will get a stock market rising. You will get a real estate market that is rising in terms of price. You will also get a rising gold price. But again, this is because the denominator is collapsing in value. Here is the bond market, and this is getting to the trick of how they got the debt to GDP to actually decline. So, very similar to how we do for the U.S. This is the government bonds for Turkey, bond yields, and we can see in yellow this is the overnight interest rate. In orange, this is the 1 year yield. And then in red is the 2 year yield, in green is the 5 year yield, and in blue is the 10 year yield. So the duration is getting longer as the color is going out the rainbow, getting darker. Hopefully that is intuitive. We can see that they have a very, very inverted bond market. Now, remember, it's normal. The normal circumstance is to have long bond yields higher than short term bond yields. This is because if you're buying that long term bond, you're taking more duration risk. We can see they had a relatively normal shaped yield curve here in 2021, 2022, with long rates at least slightly higher than the short rates. Well, with central bank policy and basically yield curve control, they have this inverted bond market where the long term bond yields are actually below the short term bond yields. Again, this is not normal. But getting to that declining debt to GDP, how did they do that? It was due to this. So here we're looking at the 10 minus the 2. This shows the inverted bond yield. Here is 0, by the way. So generally, you would see a positive sloping yield curve. And this white line, the 10-2 year spread, this should be above 0. Generally, the yield on the 10 year should be above the 2 year. Well, how did they get that declining debt to GDP? Here is the answer. Here is the real rate. So here is using the 10 year Turkish government bond yield and then subtracting the inflation rate. So what this tells you is the inflation adjusted return of buying that 10-year Turkish bond. And what we can see is that from 2021 up until 2022, they had massively negative real rates. Here at the peak or the bottom, however you want to put it, they had a real rate of return of negative 74%. If you bought a 10-year government bond here in 2022, you were going to lose 74% in real purchasing power terms. Now, remember, you will always get paid back whatever. If you put $1,000 into the bond, you'll always get that back. And you'll always get the interest rate that we were taking a look at before. You will always get that interest rate plus your return of capital. The problem is that if inflation is above the yield, the interest rate that you are getting on that bond, you are losing, especially over time, especially over long durations. So they ran massively, massively negative real rates of about at the bottom here, 73%. And again, this was around October of 2022. You might remember this is when the Turkish lira was just absolutely plummeting in value. I mean, really, the entire time of the chart, it's been plummeting. Here's what happens to the money supply. You can see that in green, this is the M2 for Turkey. We can see that it just goes absolutely parabolic. I will adjust for that parabolic rise and show it in logarithmic form. And we can see that it goes parabolic even in logarithmic form, which is supposed to adjust for exponential changes. Again, we can see this really kind of started again, even further back than kind of the height of the crisis in 2022. But the money supply was just absolutely exploding higher, as was the central bank balance sheet that we can see in this light blue. I will put that in logarithmic form again, adjusting for exponential equations. Even in logarithmic form, we can see that it goes exponential. It goes parabolic, even in logarithmic form. And again, this was during the period of time where you had 70, 80% inflation. We established that the money supply was similarly going parabolic, even in logarithmic form. And of course, the gold price just went absolutely crazy. Here from it went in 2019, in June of 2019, the gold price in lira terms was 7,643 lira per ounce. Well, it went as high as 128,000 lira per ounce. So this is what that sort of regime will look like. We established that assets will go up in value in nominal terms and in local currency terms. You will get a rapid appreciation in things like real estate or gold or the stock market. But again, if we adjust this for that collapsing currency, the collapse in the denominator, we can see that it barely set a new all time high. Stocks are generally not the best way to protect against a failing currency. Usually, gold and to some degree, real estate, scarce assets like that are generally have a higher return during these sorts of regimes. And then finally, to end here, here is what it looks like kind of for the average person. So something that I think is interesting. Here's the unemployment rate. We can see that that was at its peak here in 2019, 2020, about 14%. And then here is the monthly wage. Imagine if the monthly wage went from 3,500 in 2021 up to 20,000. This is more than a 5x increase from 2021 up until 2024. A 5x increase in the average monthly wage. Well, part of the populism here, by the way, was minimum wage increases. And at first glance, you would think, oh, well, that's great. But it's just due to the failing currency. It's just due to the fact that inflation was 85%. Well, if we adjust for that currency, that loss in currency terms, we can see that it actually it was a real wage gain. So using dollars for that monthly wage, we can see that in dollar terms, it increased from about $275 per month all the way up to $558 per month. So even in dollar terms, adjusting for the lira just absolutely collapsing, even in dollar terms, people got a real inflation adjusted wage gain. It's not just because of the failing currency. And luckily for Turkey, their unemployment rate has been falling as well from that peak of about 14% down to currently 8%. That is about double the current U.S. unemployment rate. So, anyways, hopefully that was educational, helpful. Maybe you spot a bunch of parallels, maybe you don't, but educational nonetheless. And I will catch you in the next one.